Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me back, Jim.
Wolf, is inflation going to be temporary as they keep promising us?
Yeah, so the Fed meeting just took place today, and they're still promising that it's going to be temporary, but there's starting to be, even in the Fed's estimate, some doubts about it. And certainly some of the price spikes we have seen are going to be temporary. They're going to unwind. Like lumber prices can't spike like that forever, and they've already come down by a good portion, but they're still more than double of where they used to be, a little over a year ago. And used vehicle prices, they've surged by 30% in the United States, and 18% of it in the last 2 months. And obviously that can't continue, and so some of this will eventually unwind, and we've already seen a little bit of the resistance in the market, and that volume is coming down a little bit, so there are potential buyers out there that are walking away saying, I'm not buying at these prices, that's nuts. But then at the other end of the spectrum, we've got new spikes going on in prices of different prices, in services, and airplane tickets, and hotels, and restaurants, and different things. So it is now sort of a game of whack-a-mole. We have a price spike over here that is expected to eventually back down, but not quite as much as needed. And then there's another price spike somewhere else. They all get averaged out into inflation. And inflation in the United States right now is the reddest, hottest I have seen it in decades. Depending on what measure we looked at, the last 3 months have been just a stunner. The annualized CPI increase, so that's a consumer price index increase, annualized is over 8% increase over the last 3 months. The Fed's preferred inflation measures, or that is core PCE, annualized, that jumped by 3.1% over the last 3 months, and the Fed's target is 2%. Every measure we have so far produced has surprised everybody in how far and how fast it has jumped, and how persistent some of those price increases actually have been, so some of those spikes that we have seen in prices definitely will unwind. I mean, that is clear. There's no doubt that will happen. But meanwhile, we've got these other spikes going on. So the question is, on average, will inflation persist above the rate that we would like, or that the Fed would like? And I mean, I would like to have 0% inflation, but the Fed's target per its measure is 2% inflation. And here we have the problem that now the mindset is changing. The mindset in businesses and the mindset in consumers is changing, and they're willingly paying for those higher prices. Wages are going up because companies have trouble hiring people. So we have lots of unemployed people, but somehow we end up with a labor shortage. I mean, this is one of the weirdest phenomenon I've ever seen, and so we have pricing pressures going through every level of the economy, and they're impacting how people are thinking about this now. And I mean, a car, for example, is a discretionary purpose. Most people don't have to buy a car today. They can wait a year or two before they buy a different car. And they have proven that during the financial crisis, when they went on a buyer strike that lasted for 2 or 3 years. And they just refused to buy cars. and it took a cash for clunkers program to get people started again. So people in theory could walk away and say, no, I am not paying those prices. And some people are starting to do that maybe, but not enough. And they're still willingly stepping up to the plate and paying those extraordinary prices for some of these goods and services that we're now seeing. And businesses are able to pass on those cost increases they're having because their customers, so both businesses and consumers, are changing their mind about inflation and are willing to pay more. And so inflation expectations have gone up. They've jumped to now 4% for the next 12 months, the highest in the data that goes back to just after the financial crisis. And so this whole psychological mindset of inflation is now changing, and that's what's not temporary. Now that has a more persistent or permanent impact on inflation. And so while some of these price spikes may go back down, if the expectation is the price is going to keep rising and I'm willing to pay more, and therefore I'm willing to pay my employees more, and they're willing to pay more for their food and their rent and those kinds of things, then you have a spiral going on that is very hard to deal with, and that is not temporary. So I think that's kind of what we're looking at the beginnings of, that part of this will go away and disappear, and it will be temporary. And then there is a remainder of a persistent inflation that will not go away, that's now ingrained in the system. It's ingrained in the mindset. People are expecting it. They're dealing with it at every level. And so I believe for the first time in decades, that's actually what we're looking at today.
Now, a new cost that maybe wasn't factored in, we've heard about higher prices for lumber, copper, steel. Now, apparently, there's a paint shortage caused by the Texas deep freeze that shut down a number of petrochemical plants.
Yeah, so we have these specific shortages. I mean, you wouldn't believe it. I have a Wolf Street beer mug that has a art on 3-colored art on the side around it, and there's a beer mug shortage. I'm starting to run out of those beer mugs, and I can't get the blank beer mugs. And they're made out of glass, and there's a beer mug shortage, there's a paint shortage, there's a shortage of all kinds of weird things because we have these tangled up supply chains now. My wife works in the food distribution business, has contact with the meat packers. They have a heck of a time hiring people for specialty cuts. So there's a shortage on specialty cuts of meat, and it's throughout the economy now that we have these kinds of weird, bizarre shortages. Yeah, so there was the weather in Texas that knocked down the petrochemical industry for a while. There are semiconductor issues globally. Now, there was a fire in a semiconductor plant in Japan that was specialized in automobile semiconductors. So now we have the semiconductor shortage just spreading throughout the economy. So almost everything has semiconductors in it. And we have the plastic shortages and so PVC and those kinds of things that have rippled through. So these are not signs that we're out of these products. There's just a lot of demand for it, and there's some supply constraints, and that's called a shortage. It's not that we don't have them, it's just that we're out of them, that we're a little short on them, and so the prices spike, prices go up, and they fade through the economy that way. Now, we've had a box shortage last year, a cardboard box shortage because of the boom in e-commerce. And so, everywhere you look, and that impacted me too, because I ran out of boxes to mail out my beer mugs, and I couldn't get them. And so it made me I talk in theory about these issues, and then I try to reorder the boxes for my beer mugs, and they're on back order. And so every company has to deal with these issues now, and those problems will be resolved. I mean, I'm confident that the economy is flexible enough to deal with these kinds of supply chain interruptions eventually. So the semiconductor shortage is likely to drag into next year. There are other shortages that may be resolved this year, and the lumber shortage seems to have kind of been resolved by now. And some of these things go away pretty quickly. Prices spike, the demand collapses. Like for lumber, people stop buying it, And so now the demand is way down, and prices come down to sell the inventory. And so normally on a commodity like lumber, that's how it gets resolved. In a commodity like semiconductors, that is a very different story, because you cannot just shut down manufacturing of automobiles. I mean, that's what they've been doing, and that has a very different impact than not buying something for a couple of weeks and watch the price come down. So I think we're going to deal with a supply chain mess for a while longer, and that will eventually get straightened out. I'm pretty confident that part is temporary.
Is this going to change the attitude of making things just in time, not having any stockpiles on hand in case there is some kind of a backup? We had the Suez Canal blockage that apparently caused the shortage of garden gnomes and sex toys in Europe. I guess you didn't hear much about the second one. There wasn't much buzz. But are people going to change their attitude? Maybe you should have a little extra stock on hand just in case.
Yeah, that would certainly make sense, and I'm confident that many manufacturers are looking at that. Of course, right now it's hard for them to stock up because they have trouble getting the parts they need, and you can't just rejuggle supply chains like in the automotive industry. Supply chains are very long and very complex, and there's a long lead time, so this stuff is planned months ahead of time, and so you can't just suddenly redo all of this. But there's a lot of thinking that way. Of course, when all this passes now, when somehow the supply chains go back to normal, then the cost cutters take over again, and they say, well, how can we save a little bit here, and how can we save a little bit there? And just-in-time delivery was a system that worked pretty well for quite a while, and was fairly cost effective. So, there's a good chance that they're saying, okay, we'll look at moving away from just in time, and then 2 or 3 years later, they're right back at it, because they've forgotten what it was like in 2021 to deal with all these shortages. So, that remains to be seen how manufacturers are going to deal with that. I've seen many issues like that before where they swore up and down, we're going to change it, we're going to fix it, we're not going to let that happen again. And then a few years later, different people in charge, now cost cutting sets in and they're doing it all over again.
We'll have more with Wolf Richter right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Wolf Richter. Wolf, we've just heard the average age of cars on the road has risen again. What does that tell us?
Yeah, so right now in the United States, the average age of vehicles registered legally, highway-type vehicles, so not bicycles, but vehicles admitted to drive on highways, has risen to 12.1 years. And it's jumped by 2 months on average from last year. And there's several reasons for that. One is that new vehicle sales last year plunged by 14%. So there were 14% fewer new vehicles coming into the market than normally, and so that raises the average age of the existing vehicles there. And also people drove less, a lot less, and that probably helped some older units stay on the road. They weren't driven as much, and people kept them longer, and they didn't get sent to the salvage yard. And, another factor is used vehicle exports. That's a pretty big business in the United States. And, so there may have been some changes in that last year. So anyway, so it jumped a fairly large amount, 2 months, to a record of 12.1 years. When I started out in the business, so that was in the mid-'80s, the average age of cars on the road was 7.8 years. And I remember the hand-wringing at that time, and people at the dealer level and at the manufacturing level worrying about what are we going to do when the average age keeps getting longer. Every time it rises, it means that we sell fewer cars, and that's the effect of it on automakers and on dealers. When vehicles get older, you sell fewer cars, and then for a while in the 80s, the average age actually didn't rise. It just stayed flat for a little while, and then it just soared as vehicles got better. And yet the thing is, back in when I was in college in 1976, I bought a 8-year-old Mustang with V8. It was a 289 V8 engine, and had stick shift, and it was just a basic car, and it was leaking, and the speedometer was broken, and the clutch linkage fell off, and the armrest fell off, and the paint was rusted through, and the vinyl on the seats was split open. And so it was an 8-year-old car, and it had badly deteriorated, and that's what 8-year-old cars looked like back then. Then in the mid-'80s, you had 8-year-old cars. They were still in pretty good shape. Now you have an 8-year-old car that looks almost new. So the paint is in very good shape. The interior is in very good shape. The leather interior has held up really well. The mechanicals are in good shape. We just sold last year, we sold our 14-year-old car. We bought it new, sold it last year. It looked great. It drove great. It was a gas hog, but there was nothing wrong with it, seriously. And so, we had that car for 14 years instead of cycling through a car for 3 or 4 years or 5 years, because they get, we drove that thing for 14 years and it was still in good shape, and somebody else is driving it now. And the effect is that new vehicle sales in the United States have been flat essentially for over 2 decades. So that's the unit sales. That's the number of vehicles sold in the United States have been just a little bit over 17 million at the highest points. In between, we had huge declines, like during the financial crisis. So we had these high points, and then the sales plunge, and then gradually they recover, come back up to 17 million vehicles a year, and then they drop again, like we had last year. And so this is a no-growth business in the United States, because the additional vehicles that we need come from the average age increasing. And that takes care of the additional vehicles we need. Let's just stay on the road longer. And so the industry has struggled with that. And, of course, the way they solve this is by shifting customers into more expensive models, such as more expensive SUVs and trucks, and by raising prices and, by offering more features that the customers have to pay for. So the average prices of vehicles have gone up a whole lot. This has eliminated and locked out some part of the consumers that can no longer afford a new vehicle. So now they're locked out of the new vehicle market, and obviously, they still buy cars, but they buy them used. And of course, that's the other side of the story. Now there's a lot of very good used cars out there. When you buy a 10-year-old car, it's still pretty good, and you can drive it for a whole bunch more years. And so that's what the market has shifted, that there's sort of an elite of consumers that buys new cars, and then there's a large portion that really relies on these ever older used vehicles. And meanwhile, the new vehicle industry, so the automakers, they're making these vehicles that are more and more expensive in order to keep the dollar revenues up. So we've got this circular problem. We've got this issue where the automakers are forced by competition to make vehicles that are constantly getting better, or else, automakers get pushed out of business. If they build junk, they don't, in a competitive market, they don't survive. So they're forced by competition to produce vehicles that are better and better, and because that cuts down on the number of vehicles they can sell. They're going to make it more and more expensive, which further reduces demand for new vehicles, which shifts more customers into the used vehicle market, and that cycle continues. Yeah. So I think long term, the auto industry is playing with the idea of the vehicle as a service where you just pay a subscription or something. And they've tried a few things and it hasn't worked, and hopefully it'll never work. But they're having to look at this whole model of building cars that are better and better, and we don't need more cars now. We've got all these older cars that are in perfectly good condition and still out there, and so. That's a very tough situation for the auto industry to be in. Of course, they're reveling in the dollar revenue increases and in the profit margin increases they're getting from these more expensive vehicles. But I don't know how long they can maintain that before they're losing so much volume that that can't be made up for with higher prices.
Retail sales in the U.S. have dropped. What's going on there?
Yeah, so we've had a wave of stimulus spending that included the stimulus checks that went directly to consumers. We had 3 waves of those, and so April a year ago, then in December we had another wave, and then in March we had another wave, and there are all kinds of other stimulus payments that went to consumers in addition to that. And so we had a historic spike in retail sales. And retail sales are goods, not services, but goods. So, and cars is almost a quarter of it is new used vehicles and auto parts. So that's 23% of total retail sales is related to automobiles. And, so we've had this historic spike in sales and, stimulus funded. So now the stimulus checks are petering out. So some people are still getting them, but essentially they're gone. And so in May, retail sales fell. And the interesting thing is so this is in dollars and not adjusted for inflation. So they fell in dollars. And at the same time, we had this huge bout of, price increases on these goods. So, prices are surging. So the dollar sales would have to go up based on higher prices, but dollar sales went down because unit sales went down even faster than price increases went up. And so that was the case in automobiles. It was the case in home improvement stores. The big time they had a spike in sales because of the lumber products. Price increases, that started to back down, and people started to back off from buying plywood and putting projects on hold. So we've had a fairly significant drop in a number of segments in dollar sales, even as prices have spiked. And I call this a buyer strike. When consumers are looking at higher prices and they say, I don't really need to do this right now. I'm going to wait, and I might do it next year. I might do it a month from now. I'm going to put this on the back burner. And they step away from buying the stuff and that they don't need. You need food, but you don't necessarily need the plywood, and you don't need the car, and maybe you don't need some other things. And so you can step back a little bit. And so I think what we'll be seeing going forward over the next few months is that historic spike in retail sales will unwind partially. And it will do so despite the massive price increases. Of course, consumers are still spending a lot, but some of that spending has shifted to services, so airplane tickets and hotel bookings, and they're starting to spend a little bit of money on cruises and vacation, those kind of things. So you'll see a shift to services from goods. But the astonishing thing there is that sales dropped despite these massive price increases we had, and that includes in vehicles. Now, we had this 30% increase in used vehicle prices, 18% in just 3 months, and yet used total vehicle sales dropped. So this shows that there's a significant drop off in volume coming at us, and some of that spending may be picked up in services. So that's the shift. We'll get data on that here in a little bit.
Will downtown cores ever see the kind of population they saw before during the business day? Or are we going to see virtual ghost towns in some city cores? Will people be returning to work there?
Yeah, I think everybody would like to know that. There's a lot of uncertainty about this. I think there's a consensus that it won't go back to normal, to what the old normal. Working from home is pretty popular now, and offering flexibility is important for companies that want to maintain their best employees. So, yeah, a lot of companies have some kind of hybrid model now where going forward you'll be able to work at home some of the time and you have to go to the office some of the time. So the net effect will be that there will be fewer employees in these business districts. And what the percentage, the drop-off will be when everything is said and done. So when we get out of the pandemic economy, and whenever that will be, when you in theory could populate offices as densely as you did before, the question will be how much less that population in those offices will be. And if that drops by 20%, that would be a huge, significant drop. If it it could drop more. It could drop by 30 or 40% from the old normal. So these are people that are then not showing up in these business districts, and they're not going to the office, and at least on that day, and they might go the next day, and they're not buying the sandwich or the coffee or whatever, so it has a major impact on the economies of these central business districts, and cities like San Francisco, which is sort of the epicenter, if you want to call it that, in earthquake country here, of working from home. The drop off has been very sharp, and we look at some data from Castle Office Access Systems and others. It looks like it's still down roughly 80% from the old normal. In other cities like Dallas, down 50-60%. So these are huge drop-offs in the number of employees showing up in these central business districts. And, I don't know how that will turn out. I mean, this could possibly be one of the structural changes coming out of the pandemic that will, in many ways, revolutionize how we do business. I mean, if you don't get these people to go back to the central business district, you're going to have to convert some of those buildings to housing. And that's expensive to do, and it takes many years. And so the long term, those business districts won't turn into ghost towns. They'll be converted into something else. And it has been done, and it's being done, but, this is not an overnight thing, and it will take a lot of money. And it has its good aspects too, because business districts are dead at night. And if you could put some housing in there, that would liven things up. But, I don't think to summarize it, I don't think there's any way to go back to the old normal. Whatever will happen, it will be quite a bit different than what was there before.
Vancouver, slightly different than most big cities in that we have about 100,000 people who live in the downtown core in amongst the office towers or right next to them. Will other cities start doing the same thing, have people live where they work, and maybe stop the bleeding of the big cities out to the burbs or small towns? Yeah,
so, of course, they've already done that. So in Manhattan and in San Francisco, too, there are residential towers near the office towers. And, so there's some mingling already going on between that. It's been there for decades. But it's, it may not be nearly enough. And when you go down major business street, like in the financial district in San Francisco, on Montgomery Street, it's all office towers. And there are residential towers, but they're a few blocks away. They're not right there. And south of Market, there's a sort of a mix. There's some big office towers, including the tallest building in San Francisco, the Salesforce Tower. And there's some residential mixing, but you have to go further away to get to the residential parts. So I think this will, if if they convert some of those office towers, and they will only convert the older towers. Don't convert a brand new office building to residential. The brand new office building, that the Class A building, will always find tenants. You always can find companies that want to be in the top-notch building. So it's not the Salesforce tower that you're going to convert to residential. It's the older office buildings that were built in the 60s or 70s or 80s, that you will gut and spend lots of money on and convert into nice residential units. And I think, they will do some of that, and it will make sense. It will make sense to do that in expensive cities like Vancouver and San Francisco and others, or in Manhattan, where real estate is really expensive. It makes sense to convert an old office building into a new high-end residential building, and it might not make sense in some other cities.
Wolf, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He spoke to us from San Francisco. If you have any questions for Wolf or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @Housestreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on Housestreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. Housestreet.com radio is a production of House Street Media Incorporated.